Hey, what's happening, guys? It's Friday the 15th. I got notes all over my desk. I have one of those ones you can write on, whiteboard kind of desk, just all the crap that's going on right now. Because I mean, the market's closed today. I can't give you any really indication what rates are going to do. They have been padded all to hell. So everything on our rate sheets, they took wherever it sits and bumped it up really, really high. So they don't want anybody locking today. I'm just telling you, since the markets are closed, whether you're celebrating Good Friday, whether you're celebrating Easter, you're celebrating Passover, whatever it is you're doing, they closed the markets today. It's always done that way. But because of all the volatility in the market, they took what rate they would issue, bumped it as far as rate. Cost, they bumped that up too. They want to be sure that nobody's locking because they have no idea how it's going to open on Monday. There's so much crazy volatility we've got going on right now that it's safer to just protect themselves. I mean, if you had your money, right, would you let it sit there? It's like, hey, you just dumped a few $1 billion out there sitting in your driveway. I'm gonna go to bed and go to sleep for the weekend, and hopefully that money's still there. Nah, people know you got a few $1 billion in the driveway. They're gonna come drive by your house. It's kind of how it is. Hell, you can't even leave a package on your drive on your doorstep anymore with what's going on, and risk it still being there the next day with the way the world's working. So where to start with all this stuff? So we know May is coming. Going to be here in 15 days. The claim is that the Fed is going to start unraveling their balance sheet to the tune of about $90 to $95 billion per month with respect to what they have in the bond market. It would be treasuries and mortgage-backed securities. So the way that balances out, the mortgage-backed securities should possibly be about $35 billion a month starting in May, and that's going to continue to keep going. Now, there's also a claim from the Fed that we're looking at a potential recession coming in 20 months is what the claim is, 18 to 20 months. So we got that long of them unraveling their balance sheet, right, and raising rates. So that long of a period of time, with as aggressively they plan on attacking this, there could be some pretty heavy impact in the interest rate world, right? So you think about this, I mean, inflation has gotten way out of hand, extremely out of hand. In fact, what we're looking at here, in fact, let's take a look here. The San Francisco Fed, there was another little quick article that I had read this morning. It's a comment from the San Francisco Fed. Inflation rates in the United States and other developed economies have closely tracked each other historically. The Economist wrote in an analysis published by this week. However, since the first half of 2021, U.S. inflation has increasingly outpaced inflation in other developed countries. Estimates suggest that fiscal support measures designed to counteract the severity of the pandemic's economic effect may have contributed to this divergence. That's some broad language. I don't see some broad language. That's some fancy language to say, hey, we printed a shit ton of money and it bit us in the ass. It looks like, from what I gather, from what was told to me, 40% of the current amount of the currency that's in fluctuation, it's in, I want to say fluctuation up to that right now, circulation. 40% of the currency that's in circulation today was printed in the last year and a half. Let that sink in for a second. 40% of the currency in circulation, I want to keep using that word because everything's fluctuating like crazy, right? I've used that word a lot lately. But in circulation was printed in the last year and a half. That's crazy. All that pandemic money that was going out, look what it's doing right now. Now it's put in a position where there's way too much capital out there and people are buying way too much stuff. They're sucking up too much stuff. Plus, we have supply chain issues. We don't have the amount coming in we need to. That right there is causing another situation right now. So I'm looking at a whole other place. And then you've got, what is it? Bank of America, which basically 1/3 of the people, a little bit more than 1/3 of the population of the United States has bank accounts with Bank of America. And they have recently released a report very recently showing that credit card spending is up 33% from 2019. Interesting, right? But incomes, not necessarily up that much, right? Saving, not necessarily up that much. So we don't have the amount of money being hung onto, but we still have an extreme amount of money being spent. That right there is causing us a lot of problem when it comes to this inflation thing. So other news, we've got Brandon, of course, the executive chairman of the World Economic Forum, Mr. Klaus Schwab, and Treasury Secretary Janet Yellen saying that we should be prepared for food costs to go up astronomically. Basically saying that there's just not going to be enough supply. So all tied to this oversupply of money over this period of time, now we have any sort of hiccup in the economy that was not solved by the money is going to now cause a compound problem because of the money. So just know inflation is definitely coming hard. We are sitting at 8.5% right now, and we don't know where that's going to stop. What do we got for interest rates? Let's just take a look at that particular market. So that's just a snapshot. I got like 100 things I could have talked about. I picked out those few to at least give you that heads up on with what's going on in the economy. So what do we got here as far as the market? Take a look at this beating. We continue to take. This has been one hell of a drop. We blew right past where everything dropped. Remember, we talked about that not long ago. We're approaching the levels where we were right when the pandemic hit, and we took that massive loss. We had interest rates jump to 6% practically overnight back in March of 2020, before $1 trillion was dumped in 10 days to get us back on track where we were heading and maintaining that trajectory. Now we've lost all that. I thought if we got below this, we're going to see a drop. Actually, where was it? Right in here. We'll see that drop. Well, look at that. We did see that drop. It was actually here. If we got here, we would see this drop. Well, look at, we've seen that drop, and it's coming, right? And it's just continued to drop. Now I'm looking at this and I'm thinking, what we probably will be watching for, and I got to adjust this chart so we can see it better, is right in here. Okay, where my crosshairs here are here, you're going to see where it converges with 2 points where it hit bottom and come back up. Where is that? If you look here to the far right here where my crosshairs are, I'm gonna line them back up again. That's 99.55. We're currently at 99.98. That means we've got to drop somewhere right around 43 basis points more to hit this point. Now, it could be 43, could be 50, could be somewhere in there. So we look at this bottom point where it was, that was 99.41. So it could be closer to 50 or 55 basis points that we drop before we even hit that level. Is that going to stop this plunge? I don't know. This could be a big enough rock that we drop right to that floor and keep going. I don't have a chart that goes back far enough to see, right? But what I do have is kind of an idea of what, well, no, I don't. Sorry, that's not going to help us. My apologies there. So what I have looked at, right, is we take the current rate of inflation, look at this Taylor method, I believe is what they call it. The current rate of inflation, which is 8.5%, the target rate of inflation, which is 2%, right? And we figure out if we're currently at 8.5% inflation and we're at what the target has been is 2% inflation. If you're going to charge a rate of interest, what does it need to be to make any sort of return on investment if you're going to lend out your money? So at that particular scenario, you take the divergence between the two. So subtract the 2% from the 8.5%, you see what the gap is. That gap is 6.5%. Well, what is half of 6.5? That's 3.25 or 3.25. So you take that half, you add it to the target rate of inflation, right? So that half being 3.25, the half of the gap, right? Take half the gap, add it to the 2% inflation, right? The target, and then you add it to the current rate of inflation of 8.5, and you get a 13.25. That's what interest rate we should be seeing in our current economy, or at least our current environment, for anybody to be really making any money, lending money out, right? But we're not seeing that. What? As investors, we're seeing in the 6s. As buying houses to live in, owner occupied, we're seeing in the 5s. First time we've seen that since 2010. And if you look, it's been since 2010 that we've been on this run with housing. It's just been on a run like crazy. So run is possibly going to slow down a bit here, probably quite a bit. But the reason I'm bringing this up is if you're getting these rates today in the 6s for an investor, in the 5s for an owner occupied, quit thinking about what we lost yesterday or day before, or 6 months ago. Think about where we're going. You better lock it in as early as you can. We've talked about our learn lock capability. We talked about our ability to protect this for up to 360 months on a house. You have to have an address, right? We have to be able to lock it in on the street address, right? But if we'll talk about the terms, protect it. It's worth looking at. You don't have to, right? You're making the decisions, your real estate investment business, but we're trying to come up with ways to help you protect yourself against what's coming, because this company is going to get crazy. But it's also interesting. I'll probably have to talk about this more, and I'll have to remind myself. I have to have Scotty and somebody remind me who watches this. The Fed's talking about releasing the FHFA is talking about releasing Fannie and Freddie from conservatorship. So they went in there, they shook everything up. They pushed these interest rates through the freaking room. It's like, oh, you guys are good now. We're going to turn you loose. I don't know where that's taking us, guys. We've got some interesting stuff coming ahead, but all I can tell you is get your 30-year fix now, get it locked in now, because this what sounds shitty right now into 6%, going to sound freaking awesome in a couple of months, I'm sure. Talk to you guys very soon.